Welcome to the Messy City Podcast, where we talk about creating the kinds of always changing, wonderfully messy cities and towns that we humans clearly love. We'll talk with those people trying to revive them or create them anew, whether they be designers, developers, builders, planners, or just anyone interested in the conversation. Thanks so much for listening. Welcome back to the Messy City Podcast. I'm Kevin Klinkenberg. Got our returning champion, Monte Anderson, in the house here today. Monte, it's always great to see you and talk to you. Where are you in Dallas? Or are you roaming around the country somewhere?
Yeah, I am in Dallas today. Glad to be here with you. But I am in Dallas. I'll be in Lafayette, Louisiana tomorrow morning, and then Elkhart, Indiana next week.
Cool.
So a lot of traveling coming up. But I'm
Lafayette's
home
a,
for this
Lafayette's a
afternoon.
really cool town.
It is. It
Yeah.
is. We've been going down there for this is our second year, and so yeah, there's a lot of good food
Yeah, I was
down
going to
there.
say amazing food, fun
Yeah,
people. It'd be a great time.
yeah,
So,
yeah. They are fun people. A lot of entrepreneurial spirit down there. They've had to do a lot with a lot of things against them,
yeah.
hurricanes and,
Yeah,
all the things that you've got in that part of the country.
that's right. That's right. Well, I guess depending on where you are, you've got something. So, like, we don't have hurricanes, but we've got tornadoes and floods. So,
Yeah. Yep. That's right. There's something always
yeah,
out there.
I know.
The
In fact,
unknowns.
I think I texted you a couple weeks ago. We were up in Dubuque, Iowa, where I know you're also doing some work, and they were dealing with the Mississippi is flooding this year. It's been very, very high, and so they've had some flooding in different portions. So, in fact, we were going to
Oh
take
my.
like one of their riverboat cruises, and we couldn't do it because the river is too high.
Yeah.
So,
Oh my. That's because that town is right in between the river and the bluffs.
yeah,
The downtown's right there in the valley, if you will, between the
yeah.
two hills.
It's really
Yeah.
cool. I had not spent a lot. I'd driven through before, but I hadn't really spent any time there. And it's really a neat little town with like incredible bones and just a
Yeah.
really pretty setting there on the river. So,
Yeah. The great thing is it doesn't have any major interstates that go through it.
but they had a lot of urban renewal. I'll say that they
Yeah.
for a small town, boy, did they have a lot of urban renewal that was done
Yeah.
there.
Yeah.
Anyway, Monty, I wanted to talk to you today. We were exchanging some emails. I sometimes subscribe to these just kind of random YouTube channels or blogs or whatever that touch on real estate or design or planning or whatever. And this is one that I shared with you that is a YouTube channel from somebody who calls himself the Real Estate God, which of course kind of made us laugh, but it was a really interesting short video. He has some pretty interesting content, especially for newbies. In this video that I wanted to talk about today, the email called it the best way to 3x your money in 2024. But really, it was like a 7-minute video that was about a basic investment strategy for real estate that I think that is similar to what you teach. And I wanted to kind of walk through this and talk about it because I think it's interesting. We've talked about financing before. We've talked about different aspects of development, but it's interesting to take it kind of step by step and help people understand how, where you put money in, how you get money out, how you make money doing some of these smaller projects.
Yeah. Yeah. That's a really big deal for people getting started, in this business. I mean, how do you get money out, right?
Yeah.
You put it in, but where does it go? And how does it come out fast? And it doesn't come out fast unless you buy and sell. That's basically the bottom line. If you don't buy and sell, it doesn't come out fast.
Mm-hmm.
Because if you buy a property and you get a loan and you restore that property and you run it and you get it leased up over time, it's not going to cash flow really great in the beginning. It's going to take a while. where I find myself these days in making money as far as pulling money out is, and this is what the big developers do: buying something, fixing it up, getting it all rented up, or buying something and getting it ready to sell, and then selling it. And that's where us small developers have to do more, like buying and selling.
Yeah.
And in my case, I charge myself, brokerage fees and management fees and things like that. So my operating company, gets commissions and gets development fees, and that's how we live. And big companies do the same thing. The big developer will buy, build a 200 unit apartment complex, lease it up, and sell it to the Ohio State Teacher Pension Fund.
Right.
And that's where the money's made.
Right.
That's where the big, quicker money is made. But it is really difficult as a small scale developer to buy a property, fix it up, build it, and you're building wealth, okay, because usually the property is going up in value, but you don't get a lot of cash flow out of it really quick.
Right.
That's just I think, in my opinion, and of course I don't know everything, it's kind of unrealistic thinking. It looks good on paper,
Yeah.
but it's unrealistic thinking.
Yeah. It seems like, so generally, when we talk about making any money in real estate, it's either you're making money off of the cash flow of the project itself, whether it's a residential project or a commercial project. It's producing more income than your expenses, so you're making a little money year after year on that, or you make money when you sell it to somebody else, assuming
Yeah.
you've added value along the way, and you're selling it for substantially more than what you put into it.
That's correct. And then depending on how much equity you put in the front, and how much
Right.
leverage or how much debt, how much loan you put on the property, will depend on what your cash flow is going to be. So if you've, like well, I've always been one for putting having as little debt as possible, because you can go through the times like we just went through in the last year or two, when interest rate, like on one of my properties, went from 4.5% to 7.5%.
Hmm.
It renewed and just went up. I mean,
Hmm.
they could have went up to 8.5%, but my bank liked me, so they did 7.5. But if you have much debt, if you have a lot of debt, first of all, you're not going to probably cash flow for a while, and then secondly, when the markets change, when the markets change, or when interest rates go up, or when vacancy goes up, then you're going to be in trouble. And that's when you see foreclosures, and that's when you see,
Yeah.
like right now, we're seeing a lot of properties on the market right now, either not so much in foreclosures, but people just needing cash, so they're selling their properties.
Right.
So
Yeah. So, like, let's just say, if a random project, that you're a small developer and you scrape together $50,000, and you put that into a deal, and then you have debt on the back of it for the balance of the project. You're either getting that 50,000 back to you when you sell it, hopefully, plus a profit, or you're getting it like drip, drip, drip over time, over a number of years. Which, like you
exactly.
said, at that small of a scale, that might be, maybe make a few $1,000s a year, but that you can't make a living off that.
Right. Well, you can't make a living off the drip, drip, drip part. You can't really make a living off that, but you can if you have 100 units. Then
Right.
okay,
Right.
then you have it, and you can, if if you have a real estate operating company like I do, where we do our own leasing and management and development and construction, so we pay ourselves to do those things.
Hmm.
If the money is available,
Right.
if there's enough, uh, to do that. But and many times these days, I put myself in better positions. I should have learned after 35 years. I should have learned, but I put myself in better positions where I can get those fees mostly. So even if the property is dripping, I'm still getting the fees for operating the property. Now I've got a big one that I'm sitting in right now in Duncanville, Texas. It's called Wheatland Plaza, which is an old strip center, with some townhomes I'm going to put on the parking lot. And right now I've got all my fees into it. I've got, I sold another property to, make the cash calls to keep this thing going, because I didn't want to get more debt right now while interest was high.
Hmm.
So I made a conscious decision not to add more debt on. In fact, I may not have even been able to get more debt on
Hmm.
because I'm in a leasing up stage. And I bought a strip center that was 60% leased and it went down to 28%. Now I'm
Hmm.
back up to 80, but I'm still not up to really breaking even, nearly up to breaking even. And when I put the 19 townhomes on the parking lot, I'm going to have a mixed use building, and then now I've got something that's operating, but it takes time. So that'll probably take me, what I just described is probably take me 4 or 5 years to get that done. So you got to last that 4 or 5 years,
Yeah. Yeah.
at negative cash flow, and
Yeah.
you've got to that negative cash flow's got to come from somewhere. So it's funny to hear, like in the podcast or the YouTube we were talking about. It's funny to hear some of the people talking about this stuff, because this would be the way I would put it on paper to show you a deal.
Right.
I would show you that in reality, it's just not that easy.
Hmm.
And you're constantly having to, you're constantly having to look for new ways of financing, or finding another property to buy and sell to make cash flow, or buy and sell something you've already got, or raising capital from what we call community impact investors, who don't expect huge high returns, but are also, they expect a little return, but they're as interested in the community impact as they are the return.
Hmm.
They're interested in both.
Yeah.
And so,
Well, so let's look at a couple of the basics that he talked about, just to clarify. He described the way he looks at it as like being a real estate private equity company. I think, I mean, that's clever, but I think it's just basically kind of the way a lot of real estate deals happen. And that is, you have general partners and you have limited partners. And I wonder if you could talk a little bit about, like, in your experience, what's the difference between the two, and what roles do they play?
yeah, like I'm the general partner or the managing partner in nearly all the deals I do, and I have partners, limited partners, or members. These days we call them members of the LLC. Same thing,
Okay.
same, but they're passive investors. And so in any real estate deal, you really need two things. And this is what I talk about in all small scale developers need two things, really. We need really a good, decent loan from a bank. And I always say a bank. Banks are still our best partners. They're going to
Mhm.
be the probably lowest interest rate. They're going to also be the toughest to underwrite you, looking at your paperwork, and, looking at you closely and asking you questions. And then you need affordable equity. Or you're either providing that equity, or the down payment, or your investor partners
Right.
are providing that down payment.
Just like
And
if you're
the
buying a house and you
same
have to
thing.
put 5% down, 10% down, 20% down, whatever it is. For a
Yeah.
real estate deal, it's the same way. And a bank is probably going to require 25% down pretty typically,
or
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 more.
35% today.
Yeah. Yeah.
Or you may want to put 35 or
Yeah.
40% today at 7.5 or 8.5% interest. Uh, I can remember years ago that used to be not be that bad of a rate, but we got used to this low rates.
Yeah.
We got it, below 5%. I call that free money. That's kind of free, really. So it really makes deals easier to do, and when they go up. But yeah, it's the same thing. You buy a piece of property, you need a loan, you need equity, whether it's 5% on an FHA loan to buy a house, or whether you got a commercial loan at a bank and you need 25, 35%. We used to say 20% down on commercial loans, but now these days I would say it's minimum 25 to 35% down
Hmm.
that banks are requiring. Not such a bad thing either, to tell you the truth, but it's kind of going back like 100 years ago when we didn't have financing.
Mm-hmm.
Because if you think about most of your and my friends, not wealthy, we didn't grow up with extreme amounts of wealth. 35% might as well be, might as well be 100%. We
Yeah.
got nothing. You got nothing. It's still a lot of money. But once you get your investors, your limited partners, your members of your LLC, your passive investors, the passive investors don't operate on a day-to-day basis. They're just like, they have stock in your deal, and they need to be accredited investors, which means they have to have a certain amount of knowledge or net worth wealth. They have to make a certain amount of income. They have to be sophisticated. An accredited investor is a sophisticated investor. In fact, it's a business person that it's like, it's not like a little old lady with their last $50,000 in the
Mm-hmm.
bank. That's a non-accredited investor, or somebody that makes less than 100,000 a year.
Mm-hmm.
That would be, non-accredited investors. So you want accredited investors, and these accredited investors, that means they're sophisticated, and if they lose their money, they're big boys and big girls. So they, buyer beware kind of, beware. So they're going to be passive partners. The general partner or the managing partner operates the real estate venture. You know, hires the contractors, hires the leasing agents, hires the property managers, hires the architects, negotiates with the bank. Quite often, in my case, the general partner would personally guarantee, the real estate notes, which I do just about on everything I do.
Mm-hmm.
I hear people talk about not personally guaranteeing these commercial real estate deals. It's not in my world real. That's just not realistic.
Yeah.
I have to
How does that even
personally.
how does that even exist? Who gets away with not guaranteeing a deal?
I hear people talk about it, on YouTube and things like that. I hear them, but it's just not. It's not realistic. There are different kinds of loans that where a lender looks at it would be a bigger real estate deal, big, where the asset is so strictly regulated by the bank or by the lender that you may get, a situation that that you don't have to personally guarantee. So the asset is lots of equity. It's the lender is really looking at everything you do, commissions paid, finish out, construction, things like that. They're approving everything, approve leases. They might as well be the owner. That's the only time I see that,
Hmm.
where you don't personally guarantee, your real estate in that case. But generally speaking, is general partner's got to guarantee the loan, got to run the operation. Also, has got to can get paid for running the operation.
Right.
We get paid a leasing fee, a property management fee. We get paid a development fee. We get paid all these fees if there's enough cash flow. And since I'm the one putting the deals together, I always feel responsible when there's not enough cash flow and end up leaving my fees in, because I feel responsible if I didn't make the projection, quick enough. And it seems we just never make nothing ever works as quick as I think it should. It never works as quick. And it's not. It's the nature of the beast. There's so many different. There's so many different things that can happen, whether it be building permits or zoning or platting or you know a supply or subcontractors, or didn't get a tenant early enough. I mean, um, these days in most cities have a hard time with building inspectors, so you may not get inspections as quick. We used to get building permits in 2 weeks, and we could build a building in 6 months. That's just no longer the way it is. It just takes a lot longer than that.
Hmm.
We could, it just. And I used to go to California, and they'd say, "Well, it only took me 2 years to get a permit." And I said, "Well, we're from Texas. We get a permit in like 2 weeks." Well, we're like California now. It takes us forever.
Yeah.
It takes us forever to get things. So all of those things compile up and can cause you delays and stuff like that. And delays are going to cost you money.
Yeah.
And I'm always changing things too. My projects are done incrementally. So we might start in one end, and by the time we get through, it's different than what we originally conceptualized. And it's good and bad. I mean, bad is that it's changed and it's different and likely costs more. Good is it might be a better project.
Yeah.
Because we're more curating the type of businesses or people that are there than we are
Yeah.
just
I,
filling spaces.
I mean, just like on a personal note, the town, like as an example, the townhouse project that I'm working on with my partners, um, as we have progressed through construction, we have found a lot of things that we decided we wanted to change. And a lot of that was really based on, we know like the price we're going to end up selling these at. And so it kind of changed our minds about who we think like the buyers are. It's a more expensive
Yeah.
home now than it was originally. And so, we, for example, during the course of construction, we're like, well, maybe we should change that kitchen.
Yeah.
Maybe that pantry should be different. Maybe we should have a different kind of countertop or finish. And you would think that all that would be figured out ahead of time, but like you said, during the course of the project, especially something that might take 2 or 3 years, things change.
Yeah, they do. Time happens so fast these days, and with AI and other things, I mean, the speed of everything that's happening is, if you're copying something somebody did yesterday, you're already behind. I mean, you've got to be figuring out, you got to understand this business and know where it's going rather than copying where somebody's been. You can learn from someone, but you really can't copy from place to place. Principles are the same, but yeah, like in the center I'm working in now, it's a 90,000 square foot shopping center built in the 60s. And we're converting it to mix of uses from retail and restaurants to co-working, school and, state of Texas lease and things like that. And we start off thinking we're going to get, $16 a square foot or $18 a square foot. And we'll put a little lipstick on it here and a little, fix some roofs here and stuff. What we find is if we cut the spaces up smaller and we really gut them out and really make them nice inside, we can get $24 a foot. So $24 a square foot versus 16's a lot of money,
Hmm.
to
Hmm.
the bottom line, which makes the property a lot more expensive. It's just what you just described with the townhome.
Yeah.
You got a better kitchen in, we can get more money. In fact, if we keep the cheap kitchen in, we may not sell it
Yeah.
because we found out that the market was a little bit different.
Uh-huh.
And by being an incremental or a nimble type developer, you can make those decisions on the fly and adjust and hopefully profit from that. In the meantime, you got to get more money
Yeah.
somehow.
Yeah.
So where do you get it? You either get it from your equity partners or you get it from your bank. And this is a good reason to have community. Your partners you want to have. You don't want to have poor partners.
Yeah.
You want to have rich partners, because poor partners can't help you if you get in a situation.
Well, and I like your point about the fees part of it because, I think that was something I didn't really know anything about related to development, 15 years ago, was that, like, oh, if I'm the managing partner or the developer of this project, then I essentially pay a percentage fee to myself, and that's part of the construction loan and everything.
Yeah,
And I remember, like, in the first workshops that John Anderson did that I paid attention to, he was like, it's kind of 5% of hard construction costs is in the ballpark. And so it was like, oh, that sounds good. You start to bookmark that. But then, just like you said, that can evaporate during, if things go a little bit sideways. And like on our project, we had budgeted a development fee for the three of us who are managing partners, and the construction cost changes and the inflation that's happened over the last few years have really caught up with us, and we basically having to contribute those fees back to the project to
yeah,
cover other things that we would like to do to it. So we hope to get paid out at a later date, but the reality
yeah,
is we're not going to make that fee during the course of the project.
yeah. And I would say that's more normal than not.
Yeah.
I would just say that's more normal than not because I don't know, something about in the idealistic stage. You remember when you were getting ready? I remember when you were getting ready for the townhomes and stuff. And it's the idealistic stage. It's fun during that stage. It's
Yeah.
like new love, right? It's like falling in love, and you're in love. All of a sudden, and everything is right, unicorns and rainbows. And then all of a sudden, the reality kicks in. But I think that's more normal than not. In fact, I'm embarrassed to say this, but I had a hotel project in Dallas up here, and the I was paid my development fee. I did the project in 2004 and 2005, and I sold it in 2015, and that's when I got my development fee in 2015,
Yeah.
and and it was my own fault. In fact, my own arrogance, my own, you know, my own thinking I knew everything, when I started that project that caused that to happen to me, and
Mm-hmm.
I wanted to do the project no matter what. I was just going to do it no matter what. I just wanted to do it, so, and that air, and it's like kicking the can down the road, I mean, but that own arrogance, and I tell, Bernice and I talk about this all the time, Bernice Radel, and I, don't fall in love. She says, fall in love with these projects. I say, don't fall in love with them until you own them,
Mm-hmm.
don't fall, because it excuse your, and I fell in love with this project, before I did it. And so I just had to do it anyway.
Yeah.
And sometimes, you and I were talking earlier, sometimes you just, and if you're going to do that, that's fine. Just know that the pain is coming.
Yeah.
Just know the pain is coming with it. And I understand it. I understand loving a project more than anything, and you want to do it. I understand it. Just be prepared, for the stress and the
Yeah.
high level of anxiety that will come with that.
So, Monty, that begs the question then, if you didn't get paid your development fee for 10 years, if that's more common than we'd like to admit, how do you live? How do you make a living during the course of doing these projects, because you have to have some cash flow to pay the bills on.
Yeah. So, I started off as a real estate agent, leasing and selling space, and buildings in my area, commercial real estate agent. And so, all in the beginning days, back in the early years, 100% of my business was third party broker. I was doing this for somebody else, and that was easy. I had an easy life back then, and then I decided to be a developer. And so, but what happened now today, I have about 80% is my own stuff, and 20% is other people's. About 80% today. And so you still need to be working. We call it working in the flywheel, or working in the area. You're still working to crank that flywheel, to move your company along, to move your own personal life along. You still got to make income. So I always kept brokering space for other people. And if you're an architect, so you'd still keep doing architectural work for other people, or doing your podcasting, or doing your, if you're an IT guy, you still, you're working on your IT in these buildings. You're doing work in other buildings, but you're doing it hopefully in your farm, or in your community, or in where you're committed to, where you're committed. That's a really key to this, is working in an area that you commit to as a small scale developer. You need to stay close to home, and not try to be working in Kansas City and St. Louis and Oklahoma City and Dubuque. You'll that's a good way to go broke.
Mm-hmm.
It's being too scattered out, like that. And some people can do it. I'm just not capable of doing that.
Yeah.
So you have to stay close. And that's how I make a living. And another thing is, you want to keep, I mean, it's just silly stuff to say this, but, live on half of what you make, try to get used to that. That's a really hard thing to tell
Mm-hmm.
people. And that's, try to live on half, try to really live, I've had to sell my houses before. I've had to sell my cars. I mean, I've had to, when the going gets tough,
Mm-hmm.
sometimes you got to do what you got to do. Now, knock on wood, and thankfully, by the grace of God, I've been able to build my net worth continually.
Mm-hmm.
But when you sell a property and you make a lot of money on it, or you make a profit, you've got capital gains,
Yeah.
then. And so the only way not to pay those capital gains is to trade that property, or do a 1031 tax deferred exchange, and put the money into another property. So I sell a property and I get some money, and I either pay a bunch of taxes on it, or I have to re-spend it.
Yeah.
But if I re-spend it, hopefully I can get a brokerage fee, an architectural fee, a construction fee. And so I end up living on these fees. I end up in these fees I pay myself.
Yeah.
I'm able to pay myself, and they're not, they're market fees. They're fair to my partners. Fair, you always want to put these fees and stuff in your partnership agreements. You want to put what you're going to get paid. You always want to put that in your partnership agreement, so your partners know, what you're getting paid. You want to have that up front. You don't want that to be a surprise. As you're I've got partners for like over 20 years, financial partners, and they trust me. It's whatever you want to do it.
Yeah.
And because they're used to me, taking care of them, and that's really important. Is you take care of your people that invest with you like that. You got to take. I would, if I had to, I would sell everything I had to make sure my people are whole and my banks are paid if I had to, and I just start over again. Now I haven't had to, but thankfully, but
Yeah.
I've sold things along the way when I really didn't want to sell them, to be able to keep on going.
So, I mean, I think it sounds like then, if this is a fair way to say it, that if you're doing this sort of thing, first of all, it's probably, especially for a lot of people, it's better to think of it as like a side hustle, at least initially. But more importantly, it's like it's great to be able to have one of those people in the flywheel that you would normally pay a fee to. It would be great to be able to replace yourself with at least one of those. So whether that's brokerage, property management, design, engineering, anybody that you might normally be cutting a check to, if you have an expertise in one of those areas and you can
Yes.
claim that fee, then that is a
Yeah.
way to keep getting yourself paid.
Yeah, yeah. Think about this. Think about this in your farm up there, in your Kansas City farm up there. You're working on this project right now. You're having to put your fees back in, but you're also working on a project for another guy, John Doe and Jane Doe down the street. You're doing the same things. You're still improving the neighborhood. So it's really, I don't look at it as a side hustle.
Okay.
You're doing architecture for yourself, and you're doing it for Jane and John and these other people. And then every third or fourth or fifth deal, it's your deal.
Yeah.
And every third or fourth or fifth deal, it's your deal. And then the more you get going over time, every other deal is your deal. And then every two deals is yours and one is somebody else's. And every three deals is yours and then one is somebody else's.
Yeah.
So over time, it becomes, but I think it's good as a small scale developer to have the term used, side hustle, is 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 true to be able to start right now, because right now you can adopt a place, start doing your architecture in that place, stop building, stop working on hospitals all over the country, just work in your own farm and do small jobs, do storefronts, come and help people do their lettering on their windows. If you're an architect, help them just fix things up. You make enough money to make a living, and at the same time now you're working on your townhomes.
Mm-hmm.
You're working on your townhomes, and now you find another project. And I'm always looking for an opportunity, because if I can find and what is an opportunity? An opportunity is where something is below the market. Like the shopping center I bought, 90,000 square feet, 60% occupied. The rates were like $6 or $7 a foot per year. When I get through, it's 90,000 square feet. The rates are $22, $24 a square foot. So I bought it. It was way below the market, but the market saw it as a $6 building. The market didn't see it as a $24 building because it had the cheap kitchens, like you say, in the townhouse. It had, so we put good kitchen. We did better, and we had to spend more, but we're able to make a lot more money. And in the long run, it will be. And I can tell you this, on all of my projects, all of them, just 100%. If I keep it long enough, I will get all my fees and a really good return, because what I'm doing is improving a farm. I'm improving a community together. And as they say, as the tide rises, so do all ships. So every time I'm improving something in that farm, the one I've got is going up in value.
Mm-hmm.
And over time, that'll go up. If we look at it at 3 or 4 years, that's where the problem is on the YouTube video that we talked about.
Right.
Is looking at stuff that's get rich quick scheme.
Yeah.
I don't know. There's guys who flip houses and do things, gals that flip houses and do things that probably they get rich. They get somewhat rich, I guess. And some of them get rich, I guess. And, you can do that. That's just never been my goal in doing real estate. My goal has been one of a town maker, of making our lives better. And I know you have the same, same goal in mind. So do most of our friends have that goal. We want to make the built environment better. It's money's important, but it's not it's not always the only important thing.
Yeah, I think you kind of took the words right out of my mouth. It's like you're not describing a get rich quick scheme at
Yeah,
all, but you're describing something that has a different kind of reward that somebody had. Obviously, your goal is still to make money and make good money if you're smart about it, but you're not going to be rolling up in a brand new Maserati in 2 years or something like that.
yeah,
It's
yeah,
because your goal is really to improve your place
yeah,
and lift your own community up and do really good stuff along the way.
yeah. And like you said, making money. I always tell people wherever I go these days, making money is the most important thing. Doing good is equal. But I didn't say doing good is the most important thing first, and then making money. I said
Mhm.
making money is the most, because without making money, you can't continue.
Right.
You're going to be stuck. If you build those townhomes, all your money's gone and all your credit's tied up, and you weren't able to sell them or you wasn't able to get the rents, then everything you got's tied up. And I can't tell you how many friends I've got all over the country right now that are one developer and out.
Right.
They're one deal and out. And so when I get stuck on a project, and I do, I'm on one of those right now. It's just big and it's bulky, and it's hard. So I've got to continue to do these littler projects around that keep me. That's what keeps me making my own salary, and making I got to. We had a meeting with my staff this morning and said, okay, what are we going to sell right now? What's on the board that we can sell? What can we do? That's when we make our fees, brokerage fees and development fees when we sell these
Hmm.
properties. And then we can do another one. We'll fix them up. And hopefully we get to sell them to somebody good. That hadn't been the case always with me. I've sold some stuff to some people I wished I wouldn't have. But sometimes I have no choice. Sometimes I have no choice. I have to do. But the difference too in what you and I are talking about today, you're in the middle of it yourself right now, and I am in it all the time, constantly, is that we're in the middle of this, of a very difficult, complex, uh, you know, um, maybe more complex than somebody doing a big, $100 million building over here.
Yeah.
Because in $100 million building, you've got lawyers and lobbyists and architects and planners and engineers and contractors, and you've probably got a big bid and you're going to build it all at once, and it's going to be over, and it's financed by the Ohio State Teachers Pension Fund. It's financed it, and it's probably easier because the developer didn't have to be. The developer is more of a financial architect, more of a financial wizard, if you will.
Right.
Whereas a small scale developer like us, um, we're everything. I mean, we're quite often we're the contractor. We're handling leases. We're going to raise the money. We went to the bank to sign the note. If the plumbing's broke, quite often I might be the one that's called, depending on when it is. If it's in the middle of the night or something like that, we're very close, and these are personal. We know the names of our tenants or our buyers. We know our people. That's the big difference. And so you got to really be, I think, more knowledgeable sometimes
Hmm.
about building, about developing and building. And I would think that this is the way people were 100 years ago. I would think 100 years ago when there was no financing, or maybe a little longer, but 100 years ago when there was no financing, and you're building these projects, in towns with all cash or borrowed money from you know, the attorney in town who had a little money,
Hmm.
or that's quite often who's building those things back in those days. Quite often it was bankers and attorneys. Back then, bankers were developers. They can't do that these days because of the laws, but quite often bankers and things were developers. And you were raising all cash and you're doing it. That's why all the buildings are small. A
Yeah.
lot smaller back in.
Yeah.
You don't see as much, and they were built incrementally. I mean, so when we talked about incremental development, we didn't invent incremental development,
Yeah.
right? I mean,
Yeah.
that's the way the beginning of time.
That's
You know,
that's the way all development was until
yes,
really fairly recently. Uh,
yeah,
So,
It
so
was.
on, I'm curious about if you could talk about some of the ways things go wrong. So you mentioned you have some friends who are like one project and out. What's going on? How does something like this really go wrong for somebody? Where or are there a couple of key mistakes to just really watch out for?
Yeah, the biggest mistake is humility, not enough humility. The biggest, I mean, really to have that open mind to really look at the reality and the facts, really have your ego checked in the reality of facts. You really need to look at those facts. Do not try to, cherry coat it. Do not, try to do that. And what happens in these cases is be a guy like you or me was starting out, you put together a deal and you put all your money in. You put all your money in just to get the plans done and, you know, down payment on the property and engineering and, you know, bank fees and attorney's fees. And you put all your money up, you got your money in, and then now you got a couple of partners and you've promised these partners, you've promised them certain things, you know, that are probably too good to be true. Kind of like the guy on YouTube.
Hmm.
Probably too good to be true. If it sounds too good to be true, it probably is.
Yeah, if it
And
sounds
we
super
promise
easy,
those.
watch out. Yeah.
Mm-hmm. And and we've promised those things, and now it's not the right we said it was, or we want to upgrade the kitchens, or I want to change the spaces. In fact, I have a meeting this afternoon at 4 o'clock after this to talk to one of my partners about this exact thing today, and saying we need more money. And then you can't get much more money. You spend 2 or 3 years getting a project together. You used all your money. You used all your in-laws' money to part of your investors. You got your credit tied up. You finally did get, let's say that in the best cases, or in some of the best cases, you got it all built. It's built, and you're for one thing, you're brain dead. You're brain dead. You're just deal dead.
Hmm.
And secondly, you've got no more money. You got no more credit. You've got to go back to work wherever you are, doing whatever you can to make money because you still had your house and your wife and your kids. You still had to, you know, and so that's actually best case in some scenarios. You didn't go broke, but in many cases where the deal maker, the promoter, the developer promises things, they might even lose their interest because they can't. Especially if it depends on how they promise the payback to the investors. You could actually lose your interest. We call that, there's a preferred return.
Hmm.
A preferred return is when you would maybe guarantee an investor return. You'd guarantee them like maybe a 6% preferred return, which means you're going to get 6% from day one in the deal. And if you can't pay me back that 6% plus a percentage of the profit, then I take your interest. And that happens. That happens a lot. And that's not as bad as a bankruptcy or a foreclosure, but you ended up doing all this work and you end up with nothing.
Hmm.
And so I never do preferred returns with anybody. I never do those. Just don't do them. There's too many unknown things. There's just too many things that can happen. Preferred return sometimes is like having a bad credit card.
Hmm.
You can't get the interest, paid
Right.
down, and it just keeps going every day while you're having delays or not getting the project done quick enough.
So then do you have a recommendation then for dealing with investors so that you don't have to do the preferred return? How would you recommend structuring
Yeah, I
something?
do. I do. I have um, what I call the whole pie. I'd say it's the promoter. And I'm going to oversimplify this. The promoter, the developer, you put up the money to pursue all the money to do the deal, the architecture, the due diligence, the earnest money, the legal money, and you sign the note. And then the investors, which you may be an investor in your own deal, if you put cash in your own deal, your investors get 50% of the deal. And they put up 100% of the cash needed, the equity needed. And as the cash flow is there, they get their equity. They get their equity back first. No percentage return. They get their equity back first, and once their equity is all paid back, then you split 50-50.
Hmm.
So you're 50% going in, you're 50%, and then they get all their money back. And here's the thing about investors: Most of the time, once they get their money back, they're very flexible then.
Mm-hmm.
Once they get their principal back. And then in the meantime, you say, well, I got no fees. How am I going to make a living? Well, you make your living off the development fee, the leasing fees, the management fees. So you're making those fees back. And then if you get the building leased up, and this is what I'm doing here where we speak right now, is I'll get this thing leased up and stabilized with no more construction going on. Then I can go out on the market and get a better loan. So I can get a better loan. Lenders during construction, you probably experienced this. Lenders are very nervous during construction.
Oh yeah, well, it's the riskiest time period.
Yeah,
so, yeah.
And so this way people get back. They get back their percentage when they get it. Here, when it comes back, you're going to get it when it comes back. Now I got to treat them right, and I got to do my best to get their money back. And that's taken me time to build relationships where I can get this done.
Mm-hmm.
And these are also community investors. And I would say, what is a community investor? It's a person it's typically a baby boomer, generally speaking, it's worth between $3 million and $20 million net worth.
Mm-hmm.
That's got to have 100, 200, 300,000, 400,000 they can put in one of your projects. Maybe there's 3 or 4 of them. Mm-hmm. If you need a bigger amount. And they're going to be like around. It's somebody you can have coffee with and talk to. They're going to be more empathetic with you. If you're honest with them, always be honest with them. Always tell them the bad news and the truth. Always. Don't hold back, and surely don't hide it.
Mm-hmm.
Don't hide. Don't do that. Don't do that. People are forgiving and better when you have a true relationship that's not full of hidden things, and it's just
right.
It's better. And it always comes out in the end. It always comes out better for you.
Yeah,
and they know you're committed. They know
you might be able to hide something for a little bit, but it's gonna come out. So
yeah, you're not going to be able. And be careful with your numbers. And I've done this. I mean, I've been too optimistic on my numbers. Because I wanted to do the project. And
mm-hmm.
I have people around me that keep me balanced in that place. I said, my longtime CFO here, he's an old banker back when he's been with me forever, but I always give him pro formas and stuff I do. I said, look, shoot holes in this, really take my stuff apart, really look at it, critique it, challenge it, tell me I can't lease that space for this much, or I can't resell it, or no way I can build a restaurant for $100 a square foot.
Mm-hmm.
It's got to be 150, no matter how you look, tell me those things. Tell me I can't manage this thing for $5 a square foot. It's got to be, critique me,
so
keep me balanced.
Yeah, I think that's great advice. Always to have somebody that you have a relationship enough with that you can ask them to poke holes in what you're doing. So, I mean, we've talked about some of the downside, but there's also, I mean, the reality is we're interested in this, and a lot of people are interested in this because there's a ton of enjoyment that comes out of it as well. Some financial, but a lot of it non-financial. I think one of the things, just for me personally, I'll never be able to shake loose the architect inside me, and I just love seeing buildings going up.
Yeah.
And I the incredible reward you have to know that you worked on something and you can see it manifested physically is pretty awesome. So there's all those things, and it kind of, like we were talking a little bit about earlier, I think one of the things that I remind myself of frequently is that sometimes you just have to make a decision to just go and to just do it. And you can definitely get paralysis analysis here in this, always hoping for the perfect timing and the perfect deal, but there's never really any such thing. And at some point you want to do your homework and everything, but there comes a point where you just got to like pull the trigger and try it and do something, right?
Yeah, I'm very guided by instinct. I mean, I'm very guided by instinct. Now, I mean, you've seen me before work on numbers and stuff. You know, I'm constantly running numbers. When I see projects, I can see it with numbers. I see the numbers and the spaces and the sizes and what the rents should be and the operations, the cost and stuff like that. But yeah, at some point, there's no way you're going to be able to prove it, and you just got to go for it. You just got to. And you're right, to see a project go from, like you've seen, go out of the ground to see it come up. I mean, to watch the framing and, from the plumbing, watching the plumbing stick up and the framing. I mean, there's something so great about that, especially when you're doing a project that's worthy, a worthy project. It's something. I mean, we were meant we were meant to be builders. I think as
Mm-hmm.
humans, especially. I mean, we were meant to be, we were meant to build and to do good things upon the earth. Hopefully, we could do better things than we've done upon the earth, but than some of the things we've done. But we were meant to be builder, and there's nothing like it to see project. I have photos all around my office of projects and things and it's just so good to see all of that and to also have made a decent living and built some wealth, and today I have my daughter and my granddaughter both work with me,
Hmm.
and to have that legacy or that start of something is like there's no way any amount of money could make me feel as good as looking at some of these projects that, and just and seeing businesses thrive and people have decent places to live. And I mean, there's something so special about that. That's otherwise I'd just be a broker today, just
Right.
brokering deals and wouldn't care. I mean, just but I think there's something in us that wants us to be town makers,
Mm-hmm.
that wants us to make our towns better. And maybe you're not the developer, maybe you're just one of the champions, the community champions, or you're just an activist in the community that supports this. It's nice to have people like that. Those are very important people to me. People that cheer me on and don't just criticize me. They're very important, to me.
Right.
They're as important as anybody, but there is something so good about that. And then you will, if you can, if you can commit, here's why committing to your neighborhood or your farm or your place for the rest of your life is so important. Because once you commit to that place like that, you commit things, the universe changes around you. It makes things easier. Well, I don't know about easier. It makes things doable. It gives you resources. It gives you things that you wouldn't have had when you make that when you don't have that commitment. It gives people come to you and they want to sell you a property cheaper, or they want to, people will invest with you. People will do things with you when they know that you're community champion like that, and then you will make money. And I think people and my partners and stuff, they want me to make money.
Yeah.
They allow me to make money on these projects. They want me to make money. I have to make them money too. But and to see all the small businesses that I deal with and the people that I've seen in housing that may not have had housing, and subcontractors and welders and carpenters and painters and people that are around me, help them build their businesses and stuff. I'm involved in all of that. I mean, I can't imagine doing anything better.
Yeah.
I don't know what it would be. Maybe I could be a missionary or something, do better work or something, but I don't know.
Well, you're a
This is
missionary of
good
sorts.
stuff.
You're
Or this is
certainly.
just good. It's good stuff. And it's good,
Yeah.
you know, and it helps. You help people. You help build a better. You hope you do. Not everything I've done is always the best, for sure, but
Yeah.
because I've made a lot of mistakes. But that would be the hope, that you are able to leave something decent.
No doubt.
By the way, my other granddaughter just graduated from Stephen F. Austin
Hmm.
in Texas, uh, to be an architect.
Oh, wow. All
So
right.
that was really cool. So she's, I got kids. So these family trees, is starting to be architects and developers and stuff. So it's
Well,
it's a good
I feel like we're starting to brainwash our kids in that regard too. We've got them, all those like HGTV type shows.
Oh yeah.
We got them watching those, and they're really enjoying them. and it's fun to watch with them. I mean, the latest one that we found, which I guess is not a new show. I guess it's like 7 years old, but there was a show called "You Can't Turn That Into a House,"
Yes.
and it was actually
Yeah.
3 guys from Kansas City who made this show, and they take these things like, they'll take a couple of school buses or a grain
Yeah.
silo or a horse trailer or whatever,
Yeah.
and turn it into like a little house. Um,
Yeah.
and it's just like the coolest thing. And they do it on these
Yeah.
ridiculous schedules and ridiculous budgets, but that act of creativity is so just, incredible. And I remember actually, I think the first one we saw of that is like this stuff kind of reminds me of Monty, because you have done some really cool, creative, unique stuff with your projects
Yeah.
that are, way outside the box on what people would normally look at for,
Yeah.
especially for your
Yeah.
retail stuff.
Yeah. Yeah. We use a lot of trailers and stuff like that. I
Yeah.
love buses and trailers and things. Yeah. Kind of cool.
So it's
Yeah.
it's fun work, and I agree. It's fun
Yeah.
to share it with others and
Yeah.
everything else. So
Yeah.
um,
We do need to make more money as small middle class developers and stuff.
yes.
We do need to make more money.
Hmm.
So we need to continue to teach each other and help each other.
Yeah.
That's another thing about the friends that you and I have. We really, I think we all pay it forward.
Hmm.
We're all always trying to help each other, I
Yeah.
think. And that's a good thing.
Well, Monty, where can people find you next? Or you mentioned earlier some places you're going to be roaming around to. Where else are you working these days?
Um, let's see, South Bend, Indiana, Elkhart, Indiana, Denton, Texas, Regina, Canada,
Hmm.
Dubuque, let's see, Lafayette, Louisiana, getting ready to start in Orlando, Florida.
Hmm.
Of course, Bernice Radel is working in Buffalo, and Jim Kuman in Minneapolis, Minnesota. And then we've done a little bit of work, or still doing work in Kansas City or in Grandview,
Hmm.
Missouri, with an abandoned golf course down there that
Hmm.
I think you remember.
Yeah.
Still working on that. They got their financing and bought that, the people that we're helping.
Good. Good.
And then you can always reach us at neighborhoodevolution.com and optionsre.com. And we're always here. We only do development, in my farm, in my
Right.
local area of Southern Dallas County. Southern Dallas County is where I work. And then we coach and teach, and train, uh, uh, help cities create ecosystems all over the country through Neighborhood Evolution.
Yeah. Well, we just ran into Bernice recently. She was here in Kansas City giving a keynote speech for a Missouri Main Streets conference. So that was kind of cool to
Yeah.
see.
And she's right outside my door right now
Oh,
here in
terrific. All right.
Texas.
Well, say hello.
She's riding with me to Lafayette tomorrow.
Good.
So,
Good.
and then yeah.
All right.
We're
Monty.
meeting Marcus King in Detroit to
Oh,
meet us
cool.
in
Good.
Lafayette. So
Good.
Marcus is coming. Yeah.
All right. Well, I'm jealous. Sounds like a fun crew. So,
Yeah.
all right, Monty. Thanks so much. This was great. Very informative. And I'm sure we will do it again.
Yeah. Thank you, Kevin.
All right. Take care.
See you soon.